This is my exact strategy for trading reversals, and I'm going to be giving it to you here today. No secret, no fluff, just 5 points that got me a 100-point move just yesterday. Most traders obsess over trying to catch these reversals, including when I first started, and end up blowing accounts instead. But when you understand how reversals actually form, you start to see what everyone else is missing. Reversals are not random. They follow a structure you can track and trade. In this video, I'm going to be revealing the reversal blueprint, my 5-step system for identifying and trading high probability reversals. You can literally copy this entire framework and apply it to your own trading. No guessing, no chasing, just a repeatable setup that you can use to flip momentum in your favor. After blowing up more in accounts than I care to admit and trading for 4 years, this has become one of my favorite setups. Because once you understand it, you'll never look at reversals the same again. Let's begin. Before we jump into the charts, let's take a look at where the most probable reversals form. Every big move we're interested in has 3 phases: accumulation, manipulation, and distribution, or what we call AMD, or the power of 3. Price moves through these stages and on every time frame. Here's a 1-hour candle on the left and 12 5-minute candles on the right. Both show the same hour. At one point, that long wick on top was a full green candle. That's the manipulation phase. Our job is to spot that manipulation as it's forming, so we can trade that transition from manipulation to distribution. Now, the concept is easy to understand. Enter inside the wick. But to do this safely and repeatably, there are 5 steps in the reversal blueprint, and it begins with bias and time frame alignment. Knowing the bias for the day helps frame your trade before it even forms. If my bias is bearish, the safest and cleanest setups are found at premium levels, where price sweeps buy-side liquidity and reverses lower. If my bias is bullish, I want to see a discount sweep. Price runs below sell-side liquidity and then reverses higher. Trading with biases gives you the best chance that your target will actually get hit. Can you trade against the bias? Sure. Just understand that the trade probably won't make a full move, so you need to make sure you manage your risk tighter and take profits sooner. In the trade I took yesterday, I took a short even though the day ended bullish overall, and we still booked a solid win because we managed the trade properly. Now, once the bias is established, we need time frame alignment between the 1-hour and the 4-hour charts. When both the 1-hour and 4-hour candles sweep liquidity in the same direction, we got alignment, and that's our first confirmation before moving on. If the 9 a.m. high marks a prior hourly high and the new 10 a.m. candle sweeps above it, that's a sweep of the 1-hour high. Now, here's the key. At 10 a.m., a brand new 4-hour candle opens. In the first few minutes, it often looks incredibly bullish, a strong green candle pushing above the previous 1-hour and 4-hour highs. But that's exactly what we expect during the manipulation phase. What looks like strength right now will later become the wick once distribution begins. This is why we do not chase the early push. We wait for confirmation that it's a trap. That same thing happens again at 2 p.m., 10 p.m., 2 a.m., and 6 a.m. Those are all 4-hour closes where the 1-hour candle closes at the exact same time, and you can see this happen on that time frame. Here's another example of the 1-hour and 4-hour alignment, except for this one, the 1-hour doesn't sweep until 11 a.m. Because the 4-hour candle spans 4 hours, it's still sweeping its previous candle high, confirming alignment even though the sweep comes later. If we take a look at my trade at 10 a.m., the candle swept both the 1-hour and the 4-hour highs. This is where I would start paying attention. I'm anticipating the wick high to form in this area. We need evidence that if price moves lower, it's just not going to be bought back up. We need price to hit a key level and have overlapping confluences. The first thing that I do is look left from the liquidity sweep. I want to know what price is reaching into that could actually cause resistance if we're looking for a move lower. I'll check the 15-minute, 1-hour, and 4-hour timeframes for any bearish fair value gaps that sit just near or above that sweep. Those imbalances are where price often reacts, where the move higher can exhaust before reversing. I'll also note whether that 1 hour or 4 hour high aligns with or is near a daily high. If it is, I'll probably wait for that sweep because the daily liquidity carries more weight. But the further away those levels are, the less relevant they become. I'm interested in nearby confluences that cluster around the swept area. Now, there are other levels that can strengthen your conviction, the midnight open or higher time frame breakers. If a breaker lines up with a fair value gap or is close to the sweep zone, that adds even more confluences, which is what I'm looking for. In short, I'm stacking as many overlapping PD arrays as I can find in one small area because overlapping structure equals strong reaction potential. Next, I want to check where the sweep is actually happening in relative to the dealing range. If I'm playing in a short, I want price to sweep up into premium, above the equilibrium of the prior range. If I'm planning a long, I want it to be in discount, below equilibrium of the previous range. So in our trade example, here is what I was actually looking at. First, we had equilibrium of the previous dealing range being tagged. That checked our premium condition. Next, we had a 4 hour fair value gap that overlapped with a 1 hour inversion fair value gap, and both lined up with a higher time frame breaker. These three elements gave the strong confirmation that if price did find resistance, I could trust it to be more than just a pullback for a move higher. Seeing these conditions alone are not enough because sometimes the confluence is just the sweep of liquidity on the 1 and 4 hour timeframes. I still want confirmation, displacement, and a change in state of delivery to prove that the reversal has begun. All right, guys, I want to talk to you about something really important here. Most traders out there are risking their own capital and they're learning the hard way. But with Take Profit Trader, you can actually practice without putting your own money on the line. They have no activation fee, they have payouts within 24 hours, and they have no profit cap. It's what I trade with every single day, and you can use the code DTJ to get 40% off your next evaluation account. It's a great deal, and you want to make sure that you're protecting your capital, trading smarter. Use that code DTJ to get 40% off, and with that, let's get back to the video. Now that our confluences are stacked and the trap is set, the only thing left is for the confirmation. We need displacement and a change in state of delivery to prove that the reversal has begun. First, I want to see aggressive movement away from the sweep zone. Not a single spike or a drop, but sequential bodies driving in one direction. For a short, sequential candles closing lower show me intent. This often prints bearish fair value gaps on the way down. We'll use these in the next step for our entry. Displacement says momentum. Change in state of delivery says structure has shifted. I want both. For a bearish reversal, price closes below the low of the up close candles that built the high. For a bullish reversal, price closes above the high of the down close candles that built the low. These closes are the change in state of delivery that I'm looking for. I prefer to see these on the 5-minute or the 15-minute time frame, which is even stronger. Waiting for displacement plus the change in state of delivery filters the fake outs and leaves you with confirmed reversals. In our trade, the sweep happened just after 10 a.m., creating our 1 hour and 4 hour highs. Then price closed below the 15-minute order block, below the lows of the series of up close candles right here. This confirmed and created our change in state of delivery. That drive lower created bearish fair value gaps. These will be used as part of our entry for the next section. With this displacement and the change in state of delivery confirmed, we're done guessing. Step 4 is where we execute, where we identify our chosen entry strategy. Now, it's important to note that everything up to this point has been about reading order flow, understanding bias, liquidity, and structure. Entry is the smallest part of the process, yet it's what most traders focus on first. Now, there are many ways that you can enter a trade. Today, we're using one of my favorites, the breaker. A breaker forms when price makes a high, it pulls back, and then makes a higher high for a bearish move. It's the exact opposite for a bullish move. The most sensitive area is the low of the breaker bar. When price returns to that level, that's where I look to enter in most cases. However, Before price actually returns to the breaker, I look for fair value gaps and inversion fair value gaps that price could reach for that may go beyond the lower part of the breaker. In our trade example, we had an aggressive up close candle that made the high and left behind a very large fair value gap. During displacement lower, price blew right through that gap, violating it, and it created an inversion fair value gap in its place. When the breaker and the inversion fair value gap overlap, I will always wait for price to reach up into that inversion fair value gap. So now that I know this, all we have to do is wait. When price reaches my area of interest, there are a few ways to enter. You can be aggressive, enter on the first touch. It's a little bit riskier, but you won't miss the move as often. Or you can be more conservative. You can wait for the candle to close. If it closes above the IFVG, it's invalid and you saved yourself a loss. Or you can use a hybrid of the two and you can watch the reaction. If it hesitates or rejects inside that level, that's your cue as long as it doesn't close above. Now, when it comes to stop loss placement, it's going to be different for everyone. It really depends on how much you're comfortable with losing per trade. If your limit is $200, your stop will naturally be tighter than someone risking $500. And that's okay. The key is that your stop size should always fit your personal risk parameters, not the chart. Now, once you know what your max risk is, check where that translates on the chart. If it's a high volatile day and your stop feels too tight, reduce your size so you can give the trade enough room to breathe and move while staying within the risk parameters that you have. In this trade, that meant allowing some flexibility as price moved inside the breaker or inversion fair value gap. Placing your stop just above C3 of the inversion fair value gap gives price room to fluctuate without invalidating the setup. Bottom line, size your position around your risk limit, not the other way around. My primary target was the equal lows for this trade. However, because I misread the bias, which happens, there was a chance that it might not actually reach it. So I mapped out an alternative take profit zone, which was the lowest 1 minute fair value gap in the range where price might find support. I ended up closing the trade there for about 100 points. And to be honest, I'm really glad that I did because it never actually hit my final target, and instead it moved higher the rest of the day. So when you're looking at picking a take profit zone, focus on obvious swing lows and fair value gaps just sitting above and below these key levels. If you've been paying attention, this strategy has fair value gaps written all over it. We use them to pinpoint where price is likely to move next, and they're the foundation behind every setup you've seen here. If you want to learn how to read fair value gaps properly and discover the 5 key principles that make them work, check out this video right here. We'll see you in the next one.